Today's episode is a deep dive into the collapse of the green hydrogen bubble, the core economics behind project cancellations, and why next-generation technologies like methane pyrolysis and natural hydrogen are taking center stage. We'll go beyond the headlines and talk real numbers, capital costs, price points, payback periods, supply and demand alignment, and the air quality impacts, NOx, SOx, and PM 2.5 that genuinely matter for public health and policy. All of this on today's Hydrogen Podcast. The last few years saw a torrent of massive green hydrogen deal announcements, especially in Europe and Australia. Plans like the German-Australian Fortescue E.ON partnership promised millions of tons of zero-emissions hydrogen flowing into EU energy grids. But in 2025, that vision has sharply receded. E.ON has abandoned mega import strategies. Fortescue cut its hydrogen division, and over $10 billion in flagship projects vanished across the UK, Germany, Australia, India, Spain, and the US. The driving force behind the reversal is straightforward economics. Green hydrogen from electrolysis remains expensive. Global costs range from $4 to $12 per kilogram, the US and EU averaging $4 to $8 per kilogram, and Asia, especially Japan, on the high end, compared to natural gas-derived hydrogen at just $1 to $3 per kilogram, and methane pyrolysis at $1.50 to $2.50 per kilogram when scaled up, especially in gas-rich regions. As a reference, a standard green hydrogen facility producing 200,000 tons yearly requires nearly $5 billion in investment, exposing the sector to outsized risk and slow payback in a world of rising interest rates and policy uncertainty. Every project cancellation over the past 18 months, from Stanwell Corporation in Australia to Air Products in the UK and ArcelorMittal in Germany, reflects a critical inability to make economics work. These reversals represent over 1 million tons per year of cost capacity. The hype bubble is bursting, moving from gold rush ambition to disciplined, market-focused correction. What survives are projects with captive demand, realistic offtake agreements, and competitive supply chain advantages. So why wasn't the green hydrogen vision delivered? First, cost trajectories didn't match early projections. Even with generous U.S. tax credits and ambitious EU policy supports, capital requirements, grid connection delays, and immature renewable capacity supply chains kept prices stubbornly high. Nearly all key European and Asian markets missed targets for grid-connected electrolysis, complicating offtake and diminishing investor confidence. Second, demand modeling failed to connect production with real buyers. The EU's 2030 goal of 40 gigawatts is unlikely to even hit 20%, as less than 7 gigawatts of projects are bankable and have secure offtake. Policy frameworks are still in flux, and regulatory delays mean industrial actors can't bet on long-term hydrogen supply at prices competitive with existing fuels. Third, and most critically, the greenwashing narrative arose because too many projects claimed broad energy independence and full decarbonization while depending on subsidies, loose certification criteria, or imported renewables. The green hydrogen standard, additionality, time matching, and geographic correlation principles have helped, but not enough to close the actual market gap. The sector's maturation reflects investor demand for clarity, certainty, and connection between technology and real economic value. Across continents, this reality check wasn't a defeat, it was an essential transition from political promises to business logic, refocusing on tangible value streams. As the bubble recedes, methane pyrolysis has surged. Economics are compelling. Recent techno-economic studies show installed capital costs for pyrolysis $800 to $1,200 per kilowatt, a middle ground between SMR and CCS and electrolyzer plants. At scale, methane pyrolysis delivers hydrogen at $1.50 to $2.50 per kilogram, with carbon pricing or credit policy making it even more competitive, above $40 to $60 per ton of CO2. Pyrolysis projects outpace SMR and green hydrogen for ROI and cash flow. Operational expenditures for methane pyrolysis are also less volatile. Sensitivity analysis demonstrates that each dollar per MMBTU increase in natural gas costs translates to 30 to 40 cents per kilogram increase in hydrogen price, making regional gas markets key to global rollout. Payback periods fall to 3 to 5 years in well-developed, large-scale central plants, especially with high-grade carbon black byproduct sales offsetting the 15 to 30% of production costs and providing extra income streams. The process is also vastly more efficient. Methane pyrolysis uses 75 to 90% less energy than electrolysis, offers rapid thermal ramp-up, and is easier to integrate with existing industrial park infrastructure. Environmental wins are real. Solid carbon byproducts mean no direct CO2. Advanced after-treatment and combustion help knock out NOx and PM2.5, while high-grade carbon sales feed battery, steel, and advanced material markets. Methane pyrolysis doesn't solve all problems, but it's a bridge, providing cheap, low-carbon hydrogen now, especially for refineries, ammonia, and steel, replacing the dirtiest fossil processes first. And even more disruptive, natural hydrogen is coming out of the ground continuously in geologic formations, from Nebraska to Mali to Australia. Where early pilot economics are available, natural hydrogen's market price is projected well below $2 per kilogram, sometimes as low as 50 cents to $1. Extraction costs collapse when the resource is high grade, requiring only purification and moderate infrastructure investment, not massive capital outlays or imported feedstock. This means enormous upside for industrial hubs located near reservoirs. Pipeline-ready hydrogen, zero direct CO2, NOx, SOx, or PM2.5 at the source. Life cycle and logistical costs are so much lower. The economics potentially transform entire regions, especially for heavy industry and chemical clusters. The Royal Society and GPT call out natural hydrogen as, quote, the next frontier, with global demand able to absorb every ton produced, if supply and resource mapping can be kept up. However, scalability, purity, and reservoir variability remain challenges. Most fields need years of assessment. National legal frameworks are catching up with this new resource. But early studies predict natural hydrogen could provide up to 20% or more of global clean hydrogen by 2050 if the sector delivers on low-cost pilot economics. As high-profile green hydrogen projects retrench, hydrogen is winning in sectors where reliability and air quality are valued. AI data centers are a prime example. Off-grid hydrogen-powered installations like the pioneering Lambda ECL Center in California deliver both energy and net water savings, while completely eliminating NOx, SOx, and PM2.5 at the point of use. Global tech and finance giants want decarbonized, resilient energy that shrugs off local grid volatility. Hydrogen infrastructure delivers, especially as methane pyrolysis and natural hydrogen drive operational costs lower. In heavy industry, rapid switchovers from coal and residual oil to hydrogen are leading to radical improvements in urban air quality. Off-road equipment producers like JCB have proven hydrogen combustion engines can meet and even surpass tough EU Stage 5 standards for NOx and particulates, opening up mass fleet replacement worldwide. And health and economic dividend is massive. Avoidable premature deaths, hospitalization costs, and lost productivity translate into billions in public savings per year. Smart cities and industrial clusters are now mandating hydrogen adoption wherever emissions reductions yield immediate public health gains, tying incentives directly to measurable NOx and PM2.5 drops in urban corridors. The green hydrogen hype cycle was painful but necessary. With billions lost and expectations reset, the sector now points to bulletproof fundamentals. Projects must pass payback, margin, and life cycle tests before drawing capital. Methane pyrolysis and natural hydrogen are leading the charge, offering industrial and air quality benefits at price points proven to scale, with flexible deployment across continents. And despite market headwinds, hydrogen's long-term global viability is intact. Economic modeling shows that with continued investment, infrastructure build-out, and smarter regulatory schemes, especially carbon and methane pricing, the hydrogen market will see cost parity with fossil options before 2035. Cluster projects, robust certification, and offtake secured deals will drive gigawatt volumes as air quality, industrial demand, and digital infrastructure anchor growth worldwide. For investors and policymakers, the journey is clear. Target ROI, avoid hype, Move with caution but speed, and use regulatory levers to make clean hydrogen not just a climate solution, but an economic and public health engine for the world. In sum, today's recap exposes why the old green hydrogen playbook failed, but also why hydrogen's future remains bright, so long as the sector follows the economics, drives cost down innovation, and leverages real technology wins beyond the greenwash. Methane pyrolysis, natural hydrogen, and strategic industrial adoption are showcasing what true hydrogen success looks like. Alright, that's it for me, everyone. If you have a second, I would really appreciate it if you could leave a good review on whatever platform it is that you listen to. Apple Podcasts, Spotify, Google, YouTube, whatever it is. That would be a tremendous help to the show. And as always, if you ever have any feedback, you're welcome to email me directly at info@thehydrogenpodcast.com. So until next time, keep your eyes up and honor one another.